Coming at you live from Brooklyn and Jersey, it's Real Talk, Rates, and Repeat with your hosts, Gary and Queeny from Cliffco Mortgage. Real stories, real advice, no fluff. Let's go.
Thank you all for tuning in this week, where we have a very important topic. It's when the insurance becomes the real boss of the housing market. So with me and Queeny today, we have Miss Paula Keung, who is the broker owner of Goosehead Insurance in Jersey City. Paula, thank you for being on our podcast.
Thank you for inviting me. I'm super excited. This is fun. Insurance is fun, I promise.
Okay. Let's hear the fun stuff first then.
Okay, so, let's just really jump into it. So we keep seeing these headlines out there about insurance costs. It keeps going up, and even some carriers are pulling out of certain areas. From your perspective, what's really going on in the insurance market right now?
Okay, let me start by I'm going to back up here for a second and I know we're going to talk about the wider view of insurance. Insurance is, when you get a license in the industry, it's hung by state, obviously. And so my licenses are in New York, New Jersey, soon to be PA. The company that I'm with, Goosehead Insurance, is a franchise model. We're nationwide. So, just in general, Goosehead, we have a lot of access to, the different trends, and we're able to talk on maybe a more general level about some of the other states because we have our finger on the pulse. So that's super important. But my license is in New York and New Jersey. Okay. So when we say insurance costs going up, you can say that across the board. That is true in every possible corner of the country, especially in New Jersey, my home state, and in New York. The whole tri-state area, the whole Northeast, it's a little nutty right now. I'm personally looking at rates going from like week to week sometimes. You hit refresh because the client isn't ready or isn't sure they're going to buy the house. And then you see the rates go up. And that's just the way things are happening right now. They're going up for a number of reasons. The ones that everybody knows about because we watch the news together or, listen to, see trends in the industry because we all three of us are in the industry. A lot of it is to do with inflation. A lot of it is to do with whether or not we can get the materials into the country to fix a house. A lot of it is labor costs. How are we going to, if a house burns down tomorrow, will we be able to find a contractor that will be affordable within the confines of the replacement cost that's on that insurance policy to build a house in that same manner? Because that's in the contract. That's the promise of the insurance company, right? The insurance company is there for peace of mind and to promise you that whatever you had in that particular time when you bought that insurance policy is going to be there if anything were to happen that was catastrophic and devastating. We're going to make you whole. That's the phrase that we use. We're going to make you whole. And they can't make that promise if they don't have enough insurance on the house. And they also can't make that promise if they're not collecting enough on the policies. It's not just one policy. It's all of the millions of people they're covering. And it's just a matter of simple math. And that's the reason why the main and high level reason why the rates are going up across the country.
Okay. Well, how is this affecting somebody who's trying to buy a home today, especially first-time home buyers, where they're not really as educated, right? Are they getting priced out, or are they running into sort of different hurdles now with insurance?
I mean, well, the other thing too, before I move into that topic, I want to also add, it's also weather too, right? So like the more reasons why there could be a problem, the more that begins to increase. If it was just like, one small storm season, and we can watch the trends, we can accurately predict what could happen. But now we have many small storm seasons or many large storm seasons. So we're not really sure where people can't necessarily predict these. We have lots of smart people in the back room doing algorithms and predictions, and they can't always figure it out. So they have to, be ready for the worst, which is another reason why the prices are going up. And for this question about whether or not it's affecting the market or whether or not somebody can afford a house, it sure can. I mean, I just had a client the other day that was trying to buy in Monmouth County, and she had gone to several people before the lender brought her to me, gone on her own, called other other brokers and insurance contacts, and went online, and everything that they were telling her was, oh, your insurance should be about $300 a month, which honestly doesn't sound awful to me. For me, somebody in the industry, I'm like, $300 a month isn't horrible. I know states like Texas that are way, 10 times that a month. And for her though, it's a single family. The house is a nice little tiny Cape Cod. It's adorable. It's in great shape. But for her, $300 a month on her DTI was too much. So she couldn't afford it.
Yep.
So then she pulled out of the deal and she lost a lot of money. So that'll happen a lot more because it is affecting the industry. If you don't realize it, like you fall in love with a house and you don't realize that the insurance is because where it is or the specifics of that neighborhood or that county or that zip code, you don't realize that instead of $100 a month, you now have to pay $200 more a month. That could be a big crimp. How are you going to pay for groceries? What about gas? Like it's from a very micro level in our lives. It will affect you. So it is really important to know, what you need to expect when it comes to insurance.
Got it. Well, you touched upon something that we were talking about it before we started recording, but it's basically weather and just basically regional impact, right? How's weather and basically, and how's location play into the availability and the cost of insurance? Before we started recording, and Queen, you should hear this. Paulo had to go. You said you went to Texas, Westlake, and they were looking at homes there. How much were the homes?
I don't know how much they are on the real estate market, and I don't have my finger on the pulse as far as like who's buying these houses. But there are some beautiful houses in that area. I happen to be lucky enough to go down to the corporate office on a regular basis to do trainings and other reasons why agency owners need to go down there for meetings. And the houses in that area are they're just simply beautiful. They are stunning, out of a picture book. Cinderella should be pulling up to these houses. And I spoke to somebody casually in the office, and they're like, "Oh yeah, the insurance bill on some of those houses can be like $30,000 a year."
$30,000 for insurance. That's not property tax. That's insurance.
That's your insurance. That's your insurance on some of these gorgeous houses that we would be lucky to go and drive up to and take a tour. They're on some of these shows on on the television on HGTV. Those are the kinds of houses, and that's the insurance bill for some areas of the country.
So what kind of plays a part into that insurance bill, right? Like obviously the size of the house and all that good stuff, but does the location in terms of, you said you drive up to it. So is it like mountaintop? Is it more prone to maybe certain natural disasters or whatnot? Like what is it that's creating this $30,000 a year insurance bill? Like what do insurance agents look into to kind of come up with that number?
To be fair, insurance agents, we don't need to worry too much about, the algorithm. Like I said, there's people who are much smarter with statistics and know that help these insurance companies figure out what they need to charge. Generally speaking, I'll bring it back to New Jersey because that's my market. We remember the couple of earthquakes we just had a couple weeks ago, a couple months ago. There was like one about 6 or 7 months ago that we all felt all throughout northern New Jersey. And we were all like, what's going on here? I got a couple of phone calls after that about like, do we have earthquake coverage? Can we get earthquake coverage here? How much is earthquake coverage? And the answer is we have not historically had earthquake coverage in New Jersey. And the next answer is there are some companies that allow you to endorse it. And yes, it is incredibly expensive for what you're getting. So that's like a way of answering the whole Texas answer is that, Mother Nature is very unpredictable. We don't know where we're going to be in 10 years, 20 years. The insurance companies, their job, the people who are doing the ratings for them and figuring out what they need to charge, it's their job. And they need to figure out like if the risk in Texas is not just storms and windstorms and, this and that, it's all of these other things. And like, it's the population density. Again, back to labor. Like how much is it going to cost to really, replace this beautiful house in Texas? Is it going to cost, 10 times more every year? How are we figuring this out? So then they have to charge accordingly. And no, these houses are not on mountaintops. They're in a very flat area of Texas. Nobody is driving up in the mountains, which has its own unique set of issues, like such as how close the fire department is. That's another one that comes up in insurance markets. And insurance policies, they ask you when I'm filling out these applications to these companies to figure out who's willing to take this risk, which company I can present. There is a question about like, what's the fire? It's called the fire rating. So it goes from 1 to 9. And if you're in a place where the hydrant's right outside and the fire department's under a half mile away, you're a 1, 2, or 3. If you're in an area where the fire department will be 5 to 10 miles away and there's no hydrants, then you might be a 9 or 10 and there's a lot of trees around you. That's a 9 or 10 because before the fire department can get to you, there can be significant damage to your home. If there was like, let's say a small spark in the trees around you, right? A wildfire could take out your house. So that's one of the reasons why insurance rates can be affected from one neighborhood to the other.
Got it. So I have a question then. Let's switch a little bit as far as gears, but so what happens with people that currently have insurance? What are happening during renewals? Are people still able to renew? Because I've been hearing as far as like when people are up for renewal, some of them are getting declined because insurance companies don't want to insure them again. One, because something might happen with their, the age of their roof or because of the location. So how is that impacting sort of, I guess, the renewal market then?
Yeah, the renewal market's a big one. There's a couple of things going on that you're bringing up. There are certain people who are just being non-renewed singularly, so the insurance company is not pulling out of the market, but they look at each house now and they're much more diligent about it than they were, let's say, 7 to 8 years ago. And now they are inspecting on a more regular basis. And if they see at the renewal that the house has, in the records, it said that when you bought the insurance, it was a 12-year-old roof. Now you're 5 years later and it's a 17-year-old roof. And then they have the inspector come by, or they do a drone, or they do a satellite, and the roof looks like it's the same roof from, 5 or 10, 5 years ago when you signed up for the insurance, and now you have a 17-year-old roof. That insurance company could write you a letter and say, we are going to non-renew you on renew. We're not going to take your business. Find another home for your home unless you can show me that you're getting a new roof. So that's one kind of very popular, more, I guess I should say, is happening more often, a more frequent non-renewal. Then there's the other non-renewal where an insurance company is just pulling out of a zip code. And that happens in my market a lot. I happen to live and work in Hudson County. And Hudson County is a big one where a lot of the insurance companies have come through in the years that I've owned this franchise and said, okay, we're open for business. We want to grow our market. We're okay with the brownstones in Jersey City, the little row houses. And then suddenly 2 or 3 years later, they come back and they go, we're going to non-renew everybody in this market because we no longer want to be part of the Hudson County market. So that can happen too, because, they come in and they assess and they're like, the brownstones are too old. The sewers are too old. To them, I don't think that the brownstones are too old or the sewers. This is the insurance company saying like, it's too old of a market. The infrastructure is too tight for us. The row houses are too close, and one fire is going to destroy the houses on either side. So we don't want any part of this neighborhood, and they pull out. That happens a lot, and has happened a lot in the last couple of years.
Interesting. So, Queeny, do you want to ask? Like you asked something before we started recording regarding sort of one of your deals. Can you sort of ask that again? Because I think that's very sort of relevant, especially the type of property it was with Hudson County.
Right. So I'm working on a condo, which is a new development condo. It's only 8 units. And recently, my underwriter had told me that because the insurance policy is not written under 100% replacement cost, and it's written under ACV, actual cash value, they're saying that Fannie and Freddie is saying this is not an eligible coverage for insurance. So they will not approve the building. And this is a first for me, especially with new development. And they're saying this is something that's new that came up because of how, I guess, the aftermath of certain disasters that happened in California, and then them finding out that a lot of buildings were underinsured. So now agency loans they're just putting this general restriction across the board for all buildings in all states. What's going on with that? Is that a big deal between ACV and replacement cost coverage? Like what's a layman way of explaining the difference between the two?
I mean, that's actually a pretty common one that I've heard over the years that I've been in this industry. Most of the time, for me anyway, and for my agency, my office, I never would write a master policy or a personal lines policy on ACV if there is a loan on the subject, because that's not uncommon. Fannie and Freddie is just making that rule now. I've heard that a million times over from all the other banks that I work with. But the main reason why I can think of, if you have a new development that got an insurance policy at ACV versus replacement cost, is usually it just comes down to the amount of money the insurance is, right? So if you're buying an ACV policy, you're basically saying, okay, so if anything happens to, let's say the building catches fire in the lobby, we have to replace everything in the lobby because that's under the master policy. That's the common space. If you do it under ACV, you could save quite a bit of money because the insurance company will say, well, this whole lobby was, 15 years old at this point. So in order to rebuild it, it'll cost $30,000. But because you got the ACV on there, we're going to give you 15 and you guys cover the rest. That's a big savings for the insurance company. And it's also a big savings on the cost of the policy. So whoever's making these decisions for the condo board or even on a personal home, or, an investment property with just 2 units in it, any of those reasons, that's a big savings. You can actually cut down on your monthly cost and the HOA, common charges if you take the ACV. Replacement cost, of course, is going to mean that $30,000 lobby could be, if it's 10 or 15 years later and there's a lot of inflation, that could actually cost $40,000 at that point because of inflation and materials and whatever else. And so the insurance company is able to save money and the insured is able to save money as well. Everybody's happy unless there's a loan involved. And that's why I say whenever there's a loan, you probably shouldn't be writing that at ACV because you're probably going to run into problems with the underwriter.
Got it. And how does it make a difference if there were to, let's say, like 80% co-insurance? Is that going to help the case at all?
Well, 80% co-insurance is actually beneficial. I mean, a lot of the underwriters that I run into in banking world, because I think I'm not a lender. You guys are. Mm-hmm. And so, in your world, co-insurance means something entirely different to me. Mm-hmm. To me, co-insurance is a good thing because it means that, like, if you have 80% co-insurance, it means that if you were to write that policy, let's say a building cost $1 million to rebuild, right? And you should be insuring that at $1 million. But because your loan is much lower, you're only going to buy the insurance policy at 50%. So you're going to buy it at $500,000 because that's going to cover the cost of your loan. So that does not mean an 80% co-insurance. Co-insurance means that you have to buy at least 80% of the value of the replacement cost of the building. So you should be buying at least $800,000 of insurance for the insurance company to give you full value on your loss, up to $800,000. So they're not going to penalize you or lower your return on your loss. But if you only bought 50% of insurance at the time of your loss, the insurance company will say, well, you only bought $500,000. You should have bought $1 million. It does not meet my 80% co-insurance. I'm going to not give you the full value of your loss. So if you have a loss that's worth, let's say the lobby burns down, same example I was giving you, $30,000 loss there, I'm only going to give you half because you bought half of your insurance. So here's a check for $15,000. So even though you paid for replacement cost value on the insurance policy, you only bought $50,000 or 50% of your insurance that you're supposed to have had on the building. So all of your losses will be cut down to 50% because that's what you bought. So co-insurance is good. So that means that I don't have to pay for $1 million worth of insurance, which is a lot of insurance. I only need to buy $800,000 to meet that clause, the 80-20 clause, or the 80% co-insurance, for me to not lose out on my return on my loss.
Got it.
Very
so it's good. We like it. We like co-insurance.
So do you see the same challenge?
Well, if you compare it to ACV.
That's true.
Yes.
Do you see the same challenges? Are the same challenges going on in both the commercial industry as well as the residential, or do they have different sort of challenges for insurance right now?
Well, I mean, when you say commercial, I also think of things like general liability certificates for professionals, but we're just talking about properties here. Yes. I mean, just like what Queeny just said, same issues, right? Like if I didn't have a note on a 2-family investment property in Bayonne, and I had really great cash flow and had other investments, I might consider either self-insuring and not getting the insurance because I have plenty of cash to pay for any losses, or I might consider taking an insurance policy that was, much less coverage than I truly needed if I was to insure it at 100%. So I might take an ACV on that house, right? And so it's a much more of a consideration that people are having these days. So when you ask, like, is there a big effect on both personal lines and commercial lines? Yes, the insurance market has made it so that there's a lot more choices that people can have. So that's always good. People like choices. But at the same time, folks that are buying a single family home or, a 2-family home where they're going to live in, they might be looking at prices that are a lot higher than what they were considering because they're not able to make those choices. They have a loan, so they cannot take an ACV value insurance policy to save a little money. They didn't realize that insurance was so expensive. And so they're trying to sign for their loan and qualify with their finances. And it's a lot more than they expected. So yes, it is, it's on both sides. Like, Queenie just described how it's affecting every single person that's buying that condo unit, all the 8 people in there. have to face this problem. And so that's still the same. It's all the same. It's all the insurance industry is up against a lot of changes right now, and a lot of just mass increases that a lot of people were just not ready for, whether you were in the industry or not.
Unless you're really in the industry and you understand the ins and outs of it, most people, they won't understand how all the pieces have to fit together, right? Like, just like, and when it comes to insurance, that plays a part in our borrower's DTI. So if we're not well informed or well educated in terms of how insurance has changed, what just like estimate premiums would look like and things like that, we can very well be using an incorrect number to qualify our client. And then when it comes time for them to actually purchase those insurance, which is usually the last thing they do before closing, that can make or break a deal. So it's also on us to have our team of people and be able to say, hey, I have a client, Paula, what do you think about this? And kind of like get ahead of it, especially with all these changes happening in the industry and in the insurance industry in specific. So,
I mean, to that end, there's always going to be an answer, right? Even the woman that I explained about the Monmouth County Health we just talked about, she didn't expect it to be $300 a month. There was an answer to that one. To answer your question with an example, in that particular situation, she could have gone to a non-standard market and gotten a less expensive insurance policy. So it didn't have to be $300 a month. It just happened that she decided to pull out the deal because the one that she wanted, the companies that she wanted were going to be $300 a month. There's always going to be an answer, especially when you work with a broker, because we have lots of choices, right? So we work with both standard companies, which are heavily regulated by the Department of Banking and Insurance in each state, and non-standard insurance companies, which are not regulated by the Department of Banking and Insurance in each state. And usually that comes down to companies like Lloyd's, right? Lloyd's, we all know Lloyd's, that's the largest bank in London. And they are not regulated because they just, they are not primarily insurance companies. So they can be a bank, for instance. Johnson & Johnson is a wholesale broker that is a non-standard insurance market carrier. And so some of these other policies are the answer to some of these higher rates. You can go to a non-standard market and get a rate that makes you happy. Traditionally, it was the other way around. Traditionally, it was the non-standard market gave you coverages in markets that you just couldn't get insurance on. Like a lot of companies don't want to insure in Atlantic City, for instance, because it's right by the beach, as an example. And then the non-standard market was the only place to go for that. The only reason why they're in these markets is not just because there's no other choices. There are other choices. They're just more expensive. And traditionally, the non-standard market was more expensive. It was flip-flopped. They were more expensive because they were only capturing the market where nobody wanted to go. And now we have multiple answers. It's the standard and the non-standard. And now the non-standard can sometimes beat the price of the standard markets because they're catching up. The standard markets are saying to themselves, oh, we really cannot insure without charging way more than we traditionally have been charging, right? So now the non-standard markets, the prices have kind of evened out. And at some point, you're seeing that the non-standard market prices are coming a lot lower than the standard market carriers. So yes, there's always going to be an answer. It doesn't necessarily have to break a deal. We can get creative. We can go to the non-standard market and take some things off the policy that they don't need, which you cannot do on a standard market policy. If you've seen a policy, and we all have, you have the building, you've got the other structures, you've got the personal property, you've got the liability, and then you've got a bunch of endorsements. With a standard insurance policy that you look at, you cannot take off that second number, the other structures. But in markets like Jersey City and Bayonne, nobody has a second structure. Nobody has a fence. Nobody has a detached garage or gazebo. So in the non-standard market like Lloyd's, you can take that number off and save a little money. So you can actually get creative and save some money somewhere, cut some things out. You can play with the deductible. Some standard carriers won't go above $5,000 for their deductible. That's just the top end. And the non-standard market, you can go all the way up to $25,000 in certain situations. So there's certain ways to raise that deductible to save a lot of money. You can add wind, hail deductibles, hurricane deductibles. You can lower personal property. Lots of people are very minimalist in their lifestyle and they don't want a lot of personal property coverage on their policy. So non-standard carriers allow you to change a lot of those numbers and save some of that premium.
Interesting.
Okay, so if we ever have an insurance where, or a file or a deal where it's the insurance is the make or break, we have to make sure they call Paula. to run that through and make sure we're actually looking at what's necessary versus the cookie cutter policy, right?
Yeah, my takeaway from that is insurance was always such an afterthought, but now, given the rising cost of insurance, it feels like we should pre-approve homeowners insurance now than later on, because most people just default to whoever their current insurance carrier is, like, Geico, State Farm, or whatever, right? So obviously these smaller shops, they sometimes have an advantage.
Yeah, the usual suspects, right? That's what I call them. I think particularly in certain markets, if you're looking at a file and it's in Hudson County, Essex County, Union County, definitely want to just know what that number is. Condos are super easy, but homes, particularly in New Jersey in particular, in New York, downstate New York, everyone wants that 2-family home to be able to house hack. Everyone uses that term, house hack, right? If you have more than one unit, or if you're in any of those northern New Jersey counties, definitely want to just make sure you understand how much the insurance is going to be first as a buyer, so that you can anticipate what your monthly costs are going to be, and then your lender can also have a better hand on what your numbers should be. It's a really hard thing to do for some people, though, because of how hot the market can be sometimes, right? So you better hurry up and put that offer down right now if you want to win that house. But if you put an offer down on a house and then you go all the way through and then you wait too long and you didn't realize the insurance was going to be so much or wasn't what you expected, you might end up having to cancel the deal because none of the numbers work. So it can be a little tricky, but I think it's super important for lenders and realtors and buyers in the market to really just kind of just generally know that Zillow numbers are not real. Don't believe what you read on that list. Please don't. And know your flood maps, know a place where you can find your flood map so that you know whether or not you're going to have to buy flood insurance, because that's a whole other expense. Or if it's not in a flood zone, make sure that you know where the nearest flood zone is, so that if you should be buying flood insurance, even though you're not required to, you're ready for that expense. It doesn't have to be expensive, but you're ready and you put that into your monthly costs. So that's super important. And just know that if you have a lender that has a good insurance broker relationship, at least they can help you estimate, right? Because I know you guys put a little number in the I guess the spreadsheet saying insurance should cost about this much. I'm telling all of my friends that I talk to, I'm like, well, you probably need to raise that. They might let me look at it and I'll be like, that's going to have to be more. And I know that it's a nice surprise when something is a lot less than you think, right? So it's a lot nicer to say, oh, I should be about $300 a month and I can get you something for $250. That's a great surprise. That's another $600 you just saved. But it's really horrible if you wrote down that it should be $200 a month and it's actually $250, because that's $600 the other way. And so it's just better to overestimate than under. And I think we are slowly catching up, and people are beginning to overestimate, because I've seen a lot of crazy numbers in my several years doing this. I've seen $100 a month for a 2-family in Bayonne, which is crazy. Who's doing that? I've seen, $250 for a 4-family, and I'm like, that's insane. It's just things like that. Just let's all overestimate to be safer and to give the buyer a peace of mind rather than surprise them or stress them out at the end.
100% agree. Awesome. Thank you so much, Paula. It was really an honor to have you speak and, kind of demystify insurance a little bit for us. Until next time, thank you for joining us at
Real Talk, Rates, and Repeat.
All right. Now Paula's going to take my place on this podcast. Thank you.